Today we are going to go through one past paper question. So please bring up your 2020 March question 4B. So the first one we need to look is the requirement 1. Wherever you are going to answer the questions, please read the requirement carefully before you do anything. So look at the required. For the requirement 1, discuss how the 16 million provision associated with e-commerce company moved to a new head office. So this is the first questions that they ask in requirement 1. Okay, so we highlight this is the first question. And second one, and the sublet of its own head office should be accounted for. So this one is the second question they are asking for. So in this requirement, we just need to focus to answer these two questions, and that's fine. Remember, the time that you got to answer questions in your SBR is limited. So don't waste any time in writing nonsense, okay, in the answer sheet. So remember the first one, okay? So now after we read the requirement and then we know that, the requirement they are asking about IAS 37, okay? So what we need to write in the answer sheet is all around IAS 37, okay? So after we read the requirement and we know that, the story is all about provisions, okay? So after that, we go back to the questions for B. And now, the new style type of the SBR exam paper, they are very good. They have already segregated the questions and the story into different parts, which means that the requirement only related to the first part, which means that it's the head office part here. So remember, do it one by one. Don't ever read all the requirement first. Requirement 1, 2, 3, read everything, and then do it every part together. Don't do it, okay? Do it requirement 1 after read it and then finish requirement 1. And do requirement 2 after read the requirement 2 and then do the requirement 2. Don't do everything together, okay? Answer it marks by marks. Why we need to do that? Because once the time is running short, okay, at least you got some marks to gain in the examination papers. Got it? Okay. So we look at the story. The background, there is no much variable information in the background. What we need to know is that the financial year end is 2015, September 30. That's it. So now we move to the head office. When we move to the head office, we need to see that, e-commerce is committed to a plan to move blah, 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 to a building. Okay, that's all nonsense, okay? We just have a background. It is a kind of energy efficient industry, okay? And they are going to move their office, move from the current head office, which is listed, and new office, the new Greenwood building, which means that they move from the old one to the new one. And the new office, because it's a kind of Greenwood building, so they requires less maintenance. So they got some savings, which means that they want to know whether these savings, okay, can be booked into the company or not, okay? So the directors of e-commerce company believe that the Greenwood building will save the company 2 million per annum. So remember, highlight this because this is the part that we need to do. The requirement 1, they ask the 16 million provision, and we need to know how they calculate the 16 million provision, okay? So 2 million per annum over the useful life of the building and over the 2 years, which means that they calculate that it can save $4 million within the 2 years. And after that, the disruption will move to cause the company to make a loss 10 million per annum, which means that 1 year is 10 million. 2 years, that will be 20 million. So 20 million minus 4 million, and they're asking to make a provision of 16 millions. So this is the first part we need to answer, okay? Remember, in the requirement 1, we have segregated it into 2 questions. The first one, how the 16 million provision associated e-commerce move to a new office? Are we going to make the 16 million provision? Yes or no? Of course not, okay? So whenever, okay, we are now standing at the IAS 37. So you can raise up and remember our revision summary, bring to the IAS 37 part, and then how we are going to do this. Whenever we need to make a provision, okay, for the recognition part, we need to define whether it got present obligation. Present obligation results as either legal or constructive obligation. Legal, which means that you have written contract or by law, and constructive means that you have past practice or some of the company published policy, which means that you need to fulfill that obligation. So once you fulfill this recognition requirement, then you can do the provision. But we are not. So for the questions, okay, we are going to answer, okay, 2020 March question 4B, okay? So 4B. So this is the first requirement. So how you make the answering logic? The first one, is it a provision or not? Provision or not, right? So we need to stand at the point of recognition. Either whether they are present obligation or not. Legal or constructive. Remember, while you are sitting in the examinations, don't do it into words or point form. Remember to write it into sentence and paragraph. Because now I just want to show you the logic of answering these questions, so I make it simple. But remember, write it in sentence and paragraph. So, according to IS 37, right? So we need to have present obligation, either legal or constructive. So are there any obligation with the loss of 10 million? No, there is no obligation. We just a movement. So firstly, you need to stay out. ACCA cannot make the 16 million provision. Why? Not only just the recognition criteria is not fulfilled, but also what kind of the loss of 10 million is a kind of future operating losses. Remember in our lecture, okay, we have told you that all the future operating losses cannot be recognized as provision. Remember that? So a kind of provision. So this is not going to be obtained in this situation. So after we state clearly that ACCA cannot make the 16 million provision, so we need to explain the reason, because cannot make provision for future operating losses. Of 20 million, which means that 10 million per annum additional losses cannot be accounted in the books and cannot be realized. So 2 years, 20 million cannot be. And also, as well as the 2 million saving cannot take account of 2 million per year saving counted as income or losses net off. So how they calculate the 16 million provision? They use 2 years losses, 10 million per year, right? 20 millions in total, minus the gain that the savings they earned within the 2 years, 2 to 4 million. So net off, there will be a 16 million provision. Firstly, we need to state that provision for future operating losses, according to IS 37, we cannot make that, and then we cannot count it in the books. And also, the net off of the benefit also cannot be accounted as well, because IAS 37 prohibit recognizing future operating losses. Okay? Yeah. So after the past, remember, write it in sentence and paragraph. And you have finished answer the first question. Okay? The 16 million. After that, go on. Remember, after you got the related information, and then you answer part of the question first, because time is running short in the examination. Okay? Remember, every marks you gain it first. Next. Okay? After that, the company will have to vacate its current lease head office, which means that they're going to move to the new head office. So, how about the old one? The old one, they have signed a lease contract. Okay? For the year ended 2015, September 30, the lease has 2 years to rent and rental of $600,000 per annum. And they paid advance on the 1st of October. Okay? So, according to the contract, if the lease is cancelled, the full rental is payable on cancellation, which means that no wonder you lease it, you still inside or not, you still have to pay all the rental fee, $600,000 per annum. Okay? So remember, in this situation, in the examination, remember to mark down all the key wordings and key points in the stories. Okay? So how they solve this problem? They should either pay it or they have a choice now. The leaser permits them to sublet the buildings to someone else. Okay? And they have already successfully leased to someone else for the first year, and they're going to receive $400,000 per annum, which means that they still need to pay $200,000 by themselves in order to fulfill the contract. So that's for the first year. And there's 2 years to run that rental, and they estimate that 40% of the probability that they can extend the sublease in the second year. Okay, so in this case, the lease contract, according to IAS 37, is a kind of winner's contract. Winner's contract is fulfill the present obligation. So again, we can go back to our revision summary and how we measure the winner's contract. We should measure at the lower of the cost of fulfilling the contract and the cost of termination plus penalties. So in this case, how can you gain the marks? Secondly, so according to IAS 37, right, requires winner's contract is an unavoidable cause. Right. So that's why, see that, put all the information from our revision summary into our answer booklet. So this is a kind of present obligation. So how we do the measurement? We should measure at lower of cost of fulfilling the contract. Or cost of terminate and penalties. So, in answering this type of standard application questions in the examination, remember, we need to make in accordance with the IAS or IFRS first. And after that, we need to applicate the case with brief calculations. So in this case, again, okay, we look at the last sentence. The cost of moving to a green building estimate at $1 million. Again, if this $1 million is avoidable, and then we need to put it. And also, pre-tax discount rate. Remember, when they ever give you a discount rate, it means that there is discount factor. And they remind you that maybe there will be some part that you need to calculate the present value. Of course, 2 years. And then we need to count back to the value of today, and then we need to work out the present value. So firstly, we need to calculate the unavoidable cost of the 1 year's contract, which means that the $600,000 per annum. So again, unavoidable cost of the 1 year's contract. Should be at 30 September 2015. So with brief calculation, but always remember that calculation does not earn a lot of marks in the SBR, okay? And it's just a kind of supporting your explanation, okay? So there will be $600,000. This is the current year. Plus, next year, we need to work out the present value. So after that, the total of the unavoidable cost will be around 1.17 million. Got it? So this is the unavoidable cost. And we got expectation that we can sublease it, okay? So there will be some income for us. So there will be expected benefit of subletting. And then we need to work it out for the year ended. Again, we have confirmed that the first year subletting will be $400,000. So we can get all the benefit of this part. And for the next year, we expect that only 40% of it we will have the probability. So we need to times 40%. Again, using the $400,000. But don't forget that work out the present value. Got it? So the expected benefit will be around $552,000. So after that, for the 1 year's contract, we need to make a provision. We're using the 1.17 million plus the $552,000. Sorry, minus. So this is the unavoidable cost, and this part is the benefit that we are expected to gain. So for the cost of fulfilling the contract, we just need to pay around $619,000 only. So this is the provision we need to make for the 1 year's contract. And that's not the end, because we still have the cost of the moving to the green building. So this is the cost of moving, 1 million. So we need to say if the cost of moving of 1 million is unavoidable, so according to IS 37, there is a present obligation. So the total provision will be 1.6 million, which means that 1 million plus the $619,000. Okay. And that's it. So let's have a look at the marking scheme. So for the marking scheme, 6 marks together. The first one, you state the requirement of the provision, and then whether we need to make the provision or not with explanation, 2 marks. And you need to state that future operating loss is not liable to make a provision in our books, another 1 mark. And finally, 3 marks for the 1 year's contract. You need to apply the standard. Because the 1 year's contract is an avoidable clause, that is a present obligation. And the measurement of the 1 year's contract. And after that, you need to use some calculations to support the real provision figures. And after that, you will gain 3 more marks. So this is how you gain the marks in the examination. So this is the requirement 1. So we are now looking at the requirement 2 of the questions. So for the requirement 2, we need to advise e-commerce company on the principle of accounting for the pension scheme, including calculations. So explain with the pension scheme and the calculations. Once we know that they're asking for pension, so this is related to the IAS 19, employee benefit. Okay, so after we got the concept of the requirement, and then we go back to look at the story background. And this time the question is easy and straightforward because they have stated very clearly this is a kind of defined benefit pension scheme. So according to what we have learned in IAS 19, go back to our revision summary. So there are 2 types of plans of the employee benefit. The first one we call them defined contribution, and the second one is defined benefit. What are the differences? Some of the examination, they will ask you to mention the differences, but this time, the questions, they didn't ask you to do so. Though you don't have to state the differences of these 2 plans, right? So just focus on the defined benefit plans. Remember, answer what the questions requires you to answer. Don't write any nonsense. You are not going to get any marks of it, but just wasting your time, okay? So defined benefit pension. First one, e-commerce is about the poor remuneration package offered to the employees. So they want to keep their employees in their company and then working for longer. So they try to change the pension scheme on 2015, September 30, and to all the staff. So everyone will obtain a defined benefit pension scheme, which means that they will have a guarantee and a fixed pension when they leave the company. Okay, so the benefit accrues to the date of employment, but after 2 years, blah blah blah. Okay, this is not the key part. And the net pension obligation at 78 million. So this information is also shown in the information table afterwards. So this is not the key information. We can skip it first. And during the year, benefit of 6 million were paid under the scheme, and contribution 10 million. And this is the key part. We need to do it. Okay. So this statement already record, and this is the information table. So firstly, in the marking scheme, how we state the pension scheme, and with explanation, there will be 4 marks for it, and the calculation will be 3 marks. So the calculation for the defined benefit is super easy. So get the easy mark first. Make it very clear in your answer sheet. Make table something like this to work out all the amounts that we need to put in the calculations in $1 million, and state clearly which part of it they need to charge to which part of the statement, such as P&L, other comprehensive income, or statement of financial positions. Hash 2. So I would like to do a briefly explanation to remind and recall your memory. Go back to our key notes of SBR. Remember this table in the IS 19? The concept of defined benefit, which means that the company, they need to have obligation to pay for the pension scheme to the staff when they quit the company. So every period, for example, every year, and they need to do a provision, which means that the staff, they obtained by the year of the service that they provide to the company. So that's contain a liability in the company. As well as the company, they will invest into some fundings or some investment scheme in order to use the appropriate asset to cover to the corresponding liability. So there will be another asset part that we need to pay contribution. Every year we pay to the fund, and then after investment there will be return. And we hope that the asset that we invest in can cover the liability we owe to the employee, but not that good, because sometimes maybe the liability will be much more than the asset because the asset return is not that good or not that satisfactory. Of course, we need to hope that the asset can cover it, or even sometimes the asset can cover it or even more than the liability. So once, if the planned asset closing amount is much more than the closing amount of liability, there will be a kind of, we call it net asset. Or in opposite, the liability is larger than the asset, and then we will call that net obligation. Okay? So for the asset part, we got the asset opening balance from the last year closing balance. And for that year, we got our return of the asset because we invest in, and then we got the return. And the return will be calculated in the P&L. And then we need to contribute for the year, and then through our cash payment. So that will be in the statement of cash flow. And after that, we need to work out how many benefits we paid out to the employees and work out the expected closing balance. And the closing balance of the asset for the year will according to the fair value. So the expected closing balance and the actual closing balance according to fair value, there will be differences. And we will call that remeasurement. Okay, so this is the planned asset. And for the liability obligation part, as well as we got the opening balance as per the closing balance of last year. And because this is a kind of liability, so there will be interest occurs according to the appropriate discount rate, and this will be transferred to P&L. And also the service cost, even current service cost or past service cost. Current service cost is the contribution of the employee, their service to the company for the current year. But for the past service cost, it's just a kind of adjustment or amendment of the pension scheme that related to the past service that they will put it. So in this, I just simply put it in the total lump sum as a service cost, because all of the amount of either current or past service cost, it will transfer to P&L. And also there will benefit payout, and after that we work out the expected closing balance. And the actual closing balance of the liability will work out as the present value. Again, the differences between the actual and the expected, we will measure at the kind of remeasurement gain or loss, and will be in other comprehensive income. So now, most of the examination, we will combine this asset table and the liability table together into a net template. Again, you can review this and revise it on our revision summary. Starting from the net obligation on net planned asset, this is the open balance as per last year. And then the first one, the net interest, which means that the net of the return in asset and the net of interest rate, right? After that, we got the service cost components, either current or past service cost. So minus or deduct, it depends on you got an open balance of asset or liability, right? So for the cash contribution, again, if you got a planned asset, net planned asset, so you need to add in. If you got a planned liability, just minus it. And remember, you don't have to put the benefit pay because for the two table, they got the benefit pay all together. And when you make them together, they will be set off. Okay. And after that, you will work out the expected carrying amount of the net plan asset or plan obligation. And again, you will get a closing amount that is in response of the fair value of the plan asset and the present value of the obligation. And the differences will be the remeasurement, go to the other comprehensive income. So in the examination for this case, we just simply work out, okay, the calculation part. The first one, we need to see, oh, the company is very good, already tell us that the opening and closing balance will be a net pension obligation. So we just write it, net pension obligation at 30 September 2014. Okay, so the amount of it will be 59 million. Okay, so we put it 59. Right, this according to the closing balance. And the first one, we need to add in the net interest. Already, the 59 million is combined of the net asset and the net obligation already. So we just use the 59 million times the rate. The rate we are going to use the opening rate because this is the opening amount times 5.5% of it. So there will be 3.2 million. And remember, the net interest will charge to profit or loss. Okay. After that, we got the service cost for the year. That is the current service cost, 80 million, and past service cost, 9 million. So in the questions, the key area they want to put into the examination is whether you know how this item will charge to which part of the financial statement. So they don't have the calculation techniques to work out for the service cost. They just give you an amount, and how you do the accounting treatment is the core part. So make it easy. Current service cost will be 18 million. So it will charge to P&L, okay? And past service cost, it will be 9 million. It will also charge to P&L, okay? And after that, there will be contribution. Contribution we need to minus because we got a net obligation opening. So minus contribution. $10 million. This is a kind of cash item. So not charged to P&L and OCI, but remain in the bank account and our statement of cash flow. And after that, nearly all the fixed we have put in, and then we got a closing balance of the obligation. There will be 78 million. So there will be a net pension obligation at the end of the year. It will be 78 million. And this one will leave at the statement of financial positions, closing balance. So after that, the net of the estimated closing balance is the total of this part compared with the net obligation, which is the value of the plan asset and the present value of the obligation. The differences will be our remeasurement. Remeasurement, this is the balance figure. So it will be $1.2 million. And remeasurement will be recognized in other comprehensive income. Okay, so after you work out all the calculations, wow, That's great. You already got 3 marks already. And the next one, you need to do the explanation and the application. Firstly, very simple. I would like to separate into different parts. The first part, I'm going to talk about profit or loss. For the statement of profit or loss, remember the first one, don't write in short form, in long form. We'll charge net interest based on opening discount rate. Because the basic, you are using the opening figure. That's why you need to use the opening rate to calculate the net interest. Okay, so that is the net of interest of obligation with the return of asset, which means that both of the return in asset and the interest to the obligation already net off and all included in the net interest. Okay, you need to explain it, and this will accounted in the P&L. Moreover, the statement of profit or loss will also recognize service costs. Either current and past service costs as well. For the current service cost, it represents the employee portion of their current year service to the company. Which means that they work for the company for the whole year, and then this is the part that they can obtain, right? And also for the past service costs, represent the employee portion of their employment service in power year. So the past service cost, mostly it is the current service cost of the previous year. But according to some of the change in the plan and amendment, and then they need to do some adjustment in the current year due to the past service portion. So we put in the past service cost. So you need to explain it. Result as a change of benefit plan or amendment. So for the service cost, gain or loss on settlement. So the service cost gain or loss on settlement means that the employee, they quit and then they need to settle it, or some termination of the employee, and then we need to settle the plan as well. Settlement such as redundancy plan. So again, the economy is not very good due to the COVID, and then we got a lot of redundancy plan in this field in these 2 years. So this always happens in the books of the company, and this will largely decrease the employees. Decrease the employee. Okay. So already we have finished the explanation of the P&L. Next one, we need to explain about the contribution. Contribution is a cash item paid by bank, which is paid by bank, or I would just say paid by cash, okay? So it will not be recognized in P&L or other comprehensive income. So after that, after contribution, next one is our other comprehensive income. So I would like to explain it one by one, okay? Other comprehensive income. For the other comprehensive income, there will be only remeasurement. Will be recognized in other comprehensive income. So it represents gain or loss of the plan and benefit. Good stop. So the last one is the closing balance. Closing balance is a kind of net obligation. Okay, so for the year ended 30 September 2015, the value of plan asset at fair value and obligation at closing present value. So as I told you, we need to revalue the plan asset at fair value and calculate the present value of the obligation. And this results that the obligation is bigger than the plan asset. So there will be a net pension obligation. Show the net value of net obligation in closing statement of financial positions as liability. So after you finish the application of the standard with the case story, and you will gain 4 more marks in order to get the total 7 marks. To the requirement 3 of the questions. So for the requirement 3, it asks us to calculate the impact of the above adjustment in B1 and B2. And they give you a profit before tax, 25 million for the year ended 2015, September 30. So for the 2 marks, it is completely on calculations, okay? So very easy earning of the 2 marks, but the initial things that you need to bear in mind is that you need to work out correctly for the first 2 parts in order to get the final marks, okay? So just make it simple, and then we make a table with $1 million and profit before tax, before adjustment. It will be $25 million. And number 1, we have the onerous contract provision, 1.6 million. Okay, remember for the requirement 1. Okay. So we will debit to the P&L and credit to the provisions. So it will be hit in the P&L. 1 year's contract provision. $1.6 million. So it will lower the profit for the year. And secondly, this one will be the net interest. For requirement 2. Requirement 2, we got the net interest and also the current and past service costs. For the net interest, it is 3.2 million. And also, we got again, requirement 2 again. We got the past and current service costs. So the total amount will be 18 million plus 9 million. So the total service cost will be 27 million. So after we use the profit before tax of 25 million and do all the adjustment, we will result in a loss before tax. It's a loss after that, after adjustment. It will be 6.8 net loss. So after you work it out, and you will get the final 2 marks.